Good morning, can you hear us? Okay, mic check. Hello, 1, 2. Think we're good to go.
So was it here? Or, oh no, turn around, I guess. There we are.
Yeah, we're about to start.
I think she's just.
Nice, congratulations.
Congratulations.
This was hard, yeah.
Don't tell me that.
It's me one time.
Yeah.
It's for you, yeah.
Yeah.
Awesome.
Congrats. Yeah, that test was no joke.
You went to
Emmitsville.
Yeah, that was
Emmitsburg.
awesome. Yeah, I could have done that without
Emmitsburg.
that Maryland trip. It was awesome.
Good, that's awesome.
I said it was risk rating 2.0. We got it.
Okay, we still have a few people trickling in, so we'll give it another 2 or so minutes.
Okay, yeah, perfect. Thanks, Kate. Okay, good morning, everyone. Thank you for joining us online, and we have a group of people here in person. If you could, yes, identify yourself in the chat box, have your, if you have your name and association, that would be wonderful. Next slide. So today is Happy Tuesday. And the only reason why I know that is because at my little girl's school, they were celebrating it. So, I mean, I'm sure once we write the date, we'd realize it. But hey, this is a significant historical event. We're having a CRS user group meeting. So hopefully it'll be good. So everyone can have a happy Tuesday. Next slide, please. Again, okay, welcome everyone. My name is Keely Bingham. So I'm with the Acadiana Planning Commission and the LWI Region 5 coordinator. We have two guest speakers today. They're presenting a little bit later. We have Mr. Gil Giron. He's a regional flood insurance liaison with FEMA Region 6, and he'll be speaking about risk rating 2.0. Then we have Michelle Olivier here today in person. She's a CRS technical coordinator with ISO and Verisk Analytics. I'm going to give you a verbal meeting summary. Last we met on November 16th. We do have the recording available. It's kind of a long link, but that's on our website at planacadiana.org under watershed. So in November, we had guest speakers, Dr. Monica Ferris with UNO CHART, which is the Center for Hazards Assessment, Response and Technology. We had Pam Lightfoot with DOTD, the NFIP CRS Program Manager and Floodplain Management Coordinator. And again, we had Michelle Olivier, who is here today, the CRS Technical Coordinator with ISO Verisk Analytics. We did speak about the benefits and challenges of participating in the CRS program. Just a quick recap. So we need 400 credit points to enter the program as a Class 9 community. Could give you a 5%.
It's 500.
500,
Yeah.
yeah, okay, 500 credit points as a Class 9. Is that okay? That would give you a 5% discount on flood insurance premiums. We reviewed baseline assessment for participation. That includes, but it wasn't limited to, you have to be part of the NFIP and in good standing, meeting repetitive loss criteria, and 1 foot of freeboard requirement for a Class 8 or better. And we're going to talk more about that in depth later on in the presentation. Also, how do we convey the benefits to elected officials that CRS participation is needed? This can be challenging as it's an incentive program and not required, as you all know. And just the thought I had here, I said, while reducing flood insurance premiums is a priority, you know, we want to also reduce flooding. So I wanted just a reminder that some of the efforts your community is already doing could count towards CRS credits. We talked about public information activities like elevation certificates, brochures for flood protection information, mapping and regulations, flood hazard mapping, also stormwater management. Some of your communities have an MS4 stormwater permit, and some of those activities could count towards credits for CRS. Also flood damage reduction activities like drainage system maintenance as well. We shared various links which will be available on the recording from DOTD, FEMA, the CRS resources site, and the LSU Ag flood center maps. So again, that was a quick recap. I don't know if anyone had any questions or comments about last meeting. Well, without further ado, I think Mr. Gil Giron is on, and we have a nice presentation, again, talking about the FEMA risk rating 2.0. So Gil, can you hear us? Are you there?
Yes, I am here. Good morning, everyone.
All right, thank you. Good to hear your voice. And I've been communicating through email, so thank you so much today, and everyone is definitely looking forward to your presentation.
Okay, great. So if you don't mind, I'm going to go ahead and steal the screen.
Yes, please do.
And if I could just get confirmation that you all can see the presentation up.
Yes, we can see it.
Outstanding. So as stated, my name is Gilbert Giron. I'm the Regional Flood Insurance Liaison for FEMA Region 6. I have a really condensed version of a presentation on risk rating 2.0. The actual presentation is closer to 5 hours. So this is not going to answer all the questions, but hopefully we did pick up the most important aspects of this, and we are going to open it up for questions and answers at the end. I'm going to talk a little bit about the NFIP today, what is and what is not changing, the transition of the current policies. You know, phase 1 has already been implemented of October of last year, and we are fast approaching on phase 2. I'm going to leave you with some resources, and then of course we'll open up for some questions and answers. Before we start into risk rating 2.0, let's talk a little bit about what we have now. Currently, we got about 5 million policies in FEMA's book of business. This is written by over 60 WIOs, which we call write your own partners. FEMA cannot write 5 million policies on our own, so we rely on them to assist us. We have around $1.3 trillion in coverage, and we got about 22,525 communities who participate in the NFIP. It's important to remember that when Congress established the NFIP in 1968, it was intended to be a self-funded program with borrowing authority from the U.S. Treasury for catastrophic events. However, since Hurricane Rita, Katrina, and William in 2005, the program paid out a $17.5 billion in claims that year, and that really hurt us financially. Currently, the program is $20.5 billion in debt. For the past 6 years, we have paid a record $1.2 billion in claims. The average claims have been about $47,000. The NFIP was never designed to handle the volume and severity of the storms we have been experiencing since 2005. The program, as it currently sat before implementation of Risk Rating 2.0, was not sustainable. With all that being said, it's time to double down and leverage industry best practices to better communicate flood risk and incentivize mitigation actions to make communities more resilient. And I think this is really important when we talk about CRS. As you're going to see later on, CRS is going to be a major avenue in which communities can help control the costs of flood insurance. Okay, so let's start by revisiting why we're doing this. This new approach allows us to set actually sound rates and identify flood risks more comprehensively than ever before. The change will also address an inequity the program that has built over time that must be corrected. Specifically, policyholders with lower valued homes have been paying more than they should, and policyholders with higher valued homes are paying less than they should. The new pricing plan enables FEMA to set rates that are fairer and ensures both rate increases and decreases are both equitable. We learned from example that 2/3 of older pre-firm homes, which have some of the highest rates in the NFIP today, will see a decrease in their cost of insurance. Our new rating methodology has revealed these inequities, and as a federally mandated program allowing Congress's direction, we cannot turn a blind eye to policyholders who have been unjustly subsidizing other properties. Lastly, because of our rating methodology hasn't been updated in more than 40 years, it is not physically sustainable in its present form to withstand the frequency and intensity of recent events. And the storms we know will strike in the months and years ahead due to climate change. Equity in action will help put NFIP on a financially sound path towards a more resilient program that is accountable to taxpayers, more accurately communicates flood risk to policyholders, non-policyholders, and communities, and helps disaster survivors recover after flood. It's no secret that water can't read flood maps. Last year, 1/3, almost 33% of all NFIP claims originated from areas outside of the special flood hazard area. Under the legacy system, we essentially viewed flood risk through the lens of either being in or out of the special flood hazard area based on 2 types of flood hazards. Those hazards were either riverine and coastal storm surge flood risks. Yeah, we all know that water does not stop on a line in a flood map, and not all properties are created equal. For example, an AE zone flood risk in Arizona is not the same as a flood risks for a coastal AE zone in California, yet policyholders pay similar premiums based on the flood zone. Under the legacy methodology, we also experience what's called rate cliffs. Well, what is a rate cliff? Rate cliffs are when you have a special flood hazard area on one side of the road, and then the other you have a zone X, which is an area of minimal flooding. As I mentioned, water will not stop on an imaginary line on a map, yet those who are across the street in the area of minimal flooding will have a significantly lower flood insurance premium than those across the street in the special flood hazard area. A reminder that 33% of our claims have been in areas of minimal flooding. So that is what we are talking about when we say a rate cliff, the drastic changes in rates simply because of the location on a paper map. Under the new pricing methodology, we'll look at a structure's individual, geographic, building, and other flood risks variables to calculate a premium. So we will no longer be using the flood insurance rate maps as a direct variable to determine their premium. Instead, it's going to be more individualized risk assessments for each building. Now let's talk a little bit of the numbers we have now. So as I mentioned, we have about 5 million policies in our book of business. If you'll take a look at the orange square on the top left, you'll see preferred risk policies. Well, you'll see that they comprise almost 50% of our book of business, a large number of them, over 1.7 million, and those are single family homes. Now, if you have not heard already, preferred risk policies are being taken away. And it was not anything that was taken away lightly. We understand preferred risk policies were one of our most popular products, often resulting in very low flood insurance premiums. But preferred risk policies were only identified because of the location on a map. They were outside of the special flood hazard area, so they were eligible for the lowest of the low premium. But now that we have the capability to determine the actual flood risk of the structure, we are going to rate the premiums on its flood risk. So we know that there are zone X's out there that are more prone to flooding than certain other zone X's. So we are going to do away with the firms, and preferred risk policies are going away. Now, we do anticipate an increase in a large number of these policies that were preferred risk policies because of the new variables that are going to be added on. We'll talk about those variables here in a few minutes. Another thing that is changing, if you look at the bottom or the middle square in the bottom, the grandfathered properties, you'll see that we have about 165,000 of those in our entire book of business out of 5 million. Well, grandfathering, the term grandfathering is going away as well. We have slowly reduced the number of grandfathering policies simply because of renovations and requirements to meet new code. Buildings are demolished or bulldozed and rebuilt to compliance, so grandfathering does not apply. But grandfathering rate will still apply. What I mean on this, under the risk rating 2.0, if your policy experiences increase, the experience will cap at 18%, like it's required under the legacy system. But grandfathered policies often have a lower flood insurance premium. That means the increase will also start at a lower rate. So it makes it a little bit more marketable if someone wants to sell a policy. They'll be able to assign that policy to a new owner, and they will have the same rate, but the term grandfathering will go away. Now, there are some statutory requirements not changing, and we'll talk more about these in additional slides, but statutory programs that have been implemented by Congress, such as the pre-firm subsidized properties and the newly mapped properties, are not going away. They are going to continue on a risk rating 2.0, but their calculation on how to determine their discount is going to be changed to a percentage of the first 35,000 and then reevaluated every year. Now, one of the things I'd like to bring your attention to is the middle score in the top center. Full risk properties, we almost have 1 million of those. My opinion, those are going to be the houses that benefit the most from risk rating 2.0 because their full risk has somewhat been identified, because a lot of these properties are already considered post-firm and compliant structures. They have newer up-to-date information, such as new post-construction elevation certificates. So they could be coming in pretty close to their full risk rate, which will help them unlock all the benefits that risk rating 2.0 is going to bring to the program. So that's kind of our numbers at a point right now. So let's talk about the legacy system and how it was determined for the methodology for the flood insurance. Under the legacy pricing methodology, we relied heavily on FEMA's firms and 2 variables to determine the premium: flood zones and base flood elevations. We rely on mapping process to do all the geographic variation on a zone is rated the same everywhere, right? The BFE or depth is the sole elevation reference points used to calculate exposure to the hazard. You are either in or out of the special flood hazard area. The legacy pricing methodology is old, outdated, and full of complexities, and it's based on a rating system that was built in the 70s. And as you can see, very few rating variables went into consideration when determining flood insurance premiums. Now, in comparison, the new methodology, we have a whole new set of variables added on. We are shifting the paradigm to a new pricing methodology that takes into account a much larger set of inputs and uses actuarial and data sciences to index risk to a key set of rating variables. The new pricing methodology will provide a long overdue transformation on how the NFIP calculates premiums, bringing it more in line with private industry and automating the process to make it easier for insurance agents and more intuitive for our customers to understand. Right away, you'll notice the greater and more diverse range of rating variables that are taken into consideration to calculate a premium in contrast to the legacy methodology. The new pricing methodology uses FEMA source data, additional federal government, and commercially available data sources, and a broader range of unique geographic, building, and other variables to determine and price flood risk for each building. We will also be taking into consideration a much broader range of flood frequencies and perils by incorporating multiple insurance industry catastrophic models that capture flood frequency frequency up to the 10,000 year event. That's the Monte Carlo method, and it's capturing up to 10,000 year event based on simulations. FEMA now has data and technology to more accurately assess flood risk and price flood insurance to better reflect individual risk. So one of the biggest things that are changing are the perils that could impact the flood insurance premium. As I mentioned, under the legacy system, you were either based off of one or two flooding perils. That was either riverine or coastal storm surge. But in reality, a structure can face multiple perils, and now it can be up to 6. If it applies, then it will be applied, the weight of that peril will be applied to the flood insurance premium. So now it can be storm surge, it could be tsunami, coastal erosion, inland flood, which is fluvial for rainfall, inland flood, riverine, and Great Lakes. So if all of these apply, then all of them will be applied to the flood insurance premium. If only 1 or 2 apply, then that will be added on to the flood insurance premium. As compared to before, it was just 1 or 2. Now it can be up to 6 if they all apply. We understand that in real world, structures can be subject to multiple perils, and risk rating 2.0 allows us to collect or to assign that risk associated with where the structure is located. So let's talk about a little bit what has changed in new pricing methodology. We're going to break these down slowly, and I know we're going to want to spend some time on the variables, which we will, the rating variables. So the new pricing methodology uses actual model blending from multiple data sets that simulate thousands of time events. That's the Monte Carlo, including the use of FEMA source data that leverages mapping data integration, probabilistic flood risk analysis, and using a combination of FEMA flood map data, the National Flood Hazard Layer, non-regulatory data, and NFIP historical flood losses. So we're using all of these data sets. It's going to happen automatically with the algorithm from the risk rating engine is going to ping these data sets to see what applies to the home's address. Now, FEMA integrated additional data sets into modeling, including 3 insurance industry catastrophic models, which are really the backbone of the new rating methodology. We will be pinging the data sets off Air Worldwide for their inland, coastal, and tsunami models, CoreLogic inland and coastal models, cat risk inland, coastal, and levied areas. And we're also bringing in additional information from other federal agencies, such as USGS digital elevation models, the National Oceanic and Atmospheric Administration's coastal data set, the U.S. Army Corps of Engineers levee data set. And we have procured a couple new tools. We procured the geolocation tool. We procured the first floor height tool, and we have also procured what's going to be called the replacement cost value tool. Now, these tools will provide the information needed to write the flood insurance premium. Okay, so under the legacy methodology, NFIP primarily looked at riverine flooding and coastal storm surge. New pricing methodology will add inland flooding from heavy rains, fluvial, inland flooding, riverine, coastal erosion, Great Lakes, and tsunami flooding. A major limitation of the legacy methodology is that FEMA's only able to show the greatest peril, meaning if structure is impacted by more than one peril, or prices only account for the greatest peril facing the structure. In the real world, structures can be subject to multiple perils. Risk rating 2.0 allows us to individually assess 6 different perils and calculate a premium that reflects the risk from each one. The takeaway is new pricing methodology calculates a premium amount for each applicable peril and then adds them up on top of other fees, surcharges, and glide paths to come up with the final premium. A reminder, this is all happening on the risk rating engine. All right, cost to rebuild. Under the legacy system, we use replacement cost value in just a limited number of our cases. Those are often associated with apartment complexes or residential condominium type buildings. However, under the new pricing methodology, we will be factoring a replacement cost value as a component to all of our buildings. Not only is counting replacement cost value a standard private insurance industry practice, the NFIP recognizes that partial losses impact lower valued homes differently than higher valued homes. We know that the same amount of water in a $2 million home is likely to cost more to repair than in a $250,000 home, and the $2 million home is likely to reach the $250,000 maximum coverage limit more quickly than a $250,000 home. Partial losses comprise most of the NFIP claims. FEMA has purchased a static replacement cost value data set and replacement cost value tool from CoreLogic that will provide the building's replacement cost value where we do not already have it. And those are going to be residential complexes, commercial buildings, RC, residential condominium type buildings. The replacement cost value tool has the capability to account for the differences in building costs across the country. All right. Standardized rating tables will no longer be used. If you're familiar with the legacy system and the old flood insurance manual, you can go to the back and you would find a fee schedule. Now, if you were lucky enough to understand the schedule, you can kind of figure out how insurance is going to be for that structure. Not exactly, but close. Well, it was complex and it's really confusing and very difficult to use. So we're no longer going to publish those. All rates will have to be used using the risk rating engine through a licensed agent who sells flood insurance. Insurance agents will be the only individuals who have access to the risk rating engine at first. The new pricing methodology will take a multi-pronged approach to individual building risk factor by factoring a number of new variables, such as the distance to flooding source. Now, when we say distance to flooding source, we mean flooding source, major river, major lake, bayous, wetlands that are substantial, coastal, oceanfront, those type of flooding sources. The building occupancy, the construction type and foundation type, ground elevation and forced floor height, and number of floors and prior NFIP claims histories. We're going to break these down one by one. Okay, so the under the legacy pricing methodology, we do not take into consideration the distance to flooding source, and we are limited by only capturing the peril that has the greatest impact on the structure. Either it was riverine or was coastal flooding. Also, under the legacy system pricing methodology, while the extent of flood zones like A and V zones can serve as something of a proxy for locations' proximity to the nearest flooding source, is not a direct correlation. Under risk rating 2.0, FEMA is determining how far a building is from the closest flooding source, such as a river, coast, ocean, and or Great Lakes, and directly using that as a rating variable. It's important to understand that risk rating 2.0 is an aggregate model that uses many variables in combination to arrive at an individualized rate. It is not saying that the distance to flooding source has the exact same effect on flood risk everywhere in the country, rather that localized differences are accounted for by other variables. Building occupancy. Okay, so what we are referring to here is for the building occupancy is we want your primary homes to be covered. We want you to be able to have coverage on your home if a flood event happens. You'll be able to get back into it in a timely manner and get back with your way of life. So the building occupancy for your primary home is going to have a statutory cap of a rate increase of 18%. So your primary residence, it can be condominium, apartment, townhouse, row house, manufactured home, slab on grade type of single family home. Any one of these can be this, as long as your primary residence. If it is not your primary residence, the cap is going to be 25% for any secondary or rental homes that you have under the flood insurance. The purpose of that is to get those structures to the full risk rate as quick as possible. Their way that they are paying the rate associated with the risk of the locations of those structures. All right, construction type. Construction type is not considered in rating under the legacy system, but it will be part of rating under risk rating 2.0 for single family homes only. And remember, that comprises a vast majority of our policies. 95% of our policies are for single family homes. There will be 3 construction methods identified. We have frame, masonry, and other. Now, frame is really essentially just wood construction, or more specifically, a type of construction in which the structural parts are made of wood or metal and are dependent on a wooden metal frame for support. Masonry is just like it sounds, which is a concrete block or solid load-bearing brick construction, or more specifically consists of building structures by laying individual masonry units, such as block, brick, concrete block, and or stone. And then we have other. We know that there is a multiple types of construction methods, so it would either fit frame, masonry, or other. During the quoting process, if nothing is selected, frame will be the default. And for right now, the selection of other will be rated the same as it is frame. We are most interested in the floor primarily exposed to the flood risk, i.e. the ground floor. The distinction is based on the construction type of the first floor of the building. If this first floor is constructed with masonry, the building is rated with the masonry construction. If the first floor is framed, then the building is rated with frame construction. Using the first floor as a distinguishing factor makes sense, since you would want to rate the risk based on the floor that would be primarily exposed to the flood risk and would take the most brunt from a flood event. And during the quote and renewal process, unless noted otherwise, the policyholder, the default value for construction always frame. Now, why is risk rating 2.0 considering construction type? Well, it's already included in private market modeling and for other perils. Integrating construction type into the rating system will not likely have a significant difference in terms of premiums, but these types of homes, but at minimum will not be taken into account. On a general note, we recognize that there is an entire range of mixed constructions, types, walls, and building material that are impacted differently by flood risk. However, when choosing rating factors, there is a trade-off between complexity and precision. The factor for masonry versus wood frame is a minor factor with less precise differences compared to more important factors such as elevation, where we have more precise information available. All right, so this is a big one in my opinion. Under the legacy pricing methodology, we have almost 80 different diagrams, very confusing and complex. However, under the new pricing methodology, there will now only be 6 simple foundation types. On this slide, we see 3 of the foundations. We see slab on grade, we see basement, and we see crawl space up to 5 feet. The foundation type is a significant determinant of other aspects of rating under risk rating 2.0. The second set of 3 are going to be your elevated structures. We have elevated without enclosure on post pylon piers, elevated with enclosure on post pylon piers, and elevated with enclosure not post pylon piers. We understand that there are other building styles out there, such as split level. Now, that's going to be considered slab on grade. We have mid-level entry, which is going to be elevated with enclosure, not post pylon pier. We have hanging floors, which is really popular in our Louisiana Gulf Coast area. It's going to be treated such as elevated without enclosure. So the new flood insurance manual will have more information on what one of the 6 foundations is to be used with the other building types. And this is really going to help out a lot. One of the things that we are changing, the risk rating 2.0 will count the lowest floor only above ground. So if we go back to the basement, that basement will no longer be considered the lowest floor. The floors will only now be above ground. So the foundation type is what's going to capture the basement. So it's really interesting how that works. Okay, so one of the ways in which FEMA is attempting to streamline and simplify the user experience through risk rating 2.0 is by sourcing some of the data used for rating, including the geographic variables derived from a structure's geo-coordinates provided by FEMA's new geolocation tool. Now, this is really, really cool how this happens. The agents and the applicant, the insured, input their home address into the application, which then is transitioned to the risk rating engine. The risk rating engine then grabs that address and converts it to latitude and longitude. And then that latitude and longitude is pinged off of our geolocation tool. Now, that's going to answer a lot of questions. It's going to answer the distance to flooding source. It's going to answer the ground and surrounding elevations. It's going to be, is this location protected by levee? If it's in a watershed, what kind of watershed is in? Where along the watershed is it? Is it upstream, downstream? Is it located on a barrier island? All that's going to happen automatically in the algorithm. But most importantly, the ground and surrounding elevation are now being captured. So if you're on a high elevation, you built on a hilltop, it's going to impact that premium. And same is going to be said if you pick the areas that are low lying and are prone to flooding by rain, that's going to have impact as well. So this new geolocation tool is really important on how risk rating 2.0 is going to determine the flood insurance premiums. Okay, the first floor height. Under the legacy system, we consider floor elevation by post-firm rated structures in the special flood hazard area by using elevation certificate. Under the new price methodology, we will consider the first floor height for all buildings. This is determine how high the building's first floor sits off the ground based off of the lowest adjacent grade. Now, the lowest adjacent grade is the lowest point of where the foundation touches the ground. Now, the foundation can be either slab on grade or it could be piers, columns, and posts. We are asking the question, how high is the first floor? It's as simple as that. Now, there are going to be multiple ways to get this information. First and foremost will be the first floor height tool that we have procured through CoreLogic. We fully expect to have 80% of our book of business be able to get this information through the tool. If we do not have it there, we have two other methods. One of them is based on FEMA assumptions. FEMA assumptions are only going to be up to 2.5 feet, which is not really beneficial for houses that are very elevated on piers, piles, and posts. But the other method is even though elevation certificates will no longer be required for flood insurance, submittal of elevation certificate is the third method to determine what the first floor height is. So homeowners can still submit elevation certificates if they have this information. So this next slide is just to indicate where the first floor height is. As you can see, it is where the orange arrow indicates. And in this slide, we now add the lowest adjacent grade. It's a very simple question that we're answering, removing a lot of the complexity of what was the old system. So I kind of touched on this a second ago. The first floor height tool is provided for our insured through the tool that we have procured through CoreLogic. We talk about assumptions. This is a last case scenario where information simply can't be provided. The actuaries at FEMA headquarters determined that 2.5 feet is the maximum height that our assumptions will go. So if you have a structure that's elevated 9 feet, the assumptions will not give you a beneficial rate. But then again, once again, the submittal of the elevation certificate can, and I still encourage that. Once again, we try our best to use the most precise and accurate information we have, but sometimes if you just have a post-construction EC that has more up-to-date data, it could lead to a more advantageous rate for flood insurance. So under the legacy pricing methodology, number of floors was only part of the rate structure for some of our post-term rated buildings. Under the new pricing methodology, the number of floors will now count for all buildings, but only the number of floors above ground. So that means we will not count basements, including walkout basements, enclosures, crawl spaces, or attached garages as a floor. They will be accounted for as part of the foundation type. Why are we doing this? To bring NFIP underwriting more in line with private industry practice and to help reduce the complexity of the NFIP rating. Well, this is a good time for me to remind everyone that what we are talking about today and risk rating 2.0 and the changes are going to only impact the insurance side of the house. So if there are requirements for compliance under 44 Code of Federal Regulations 60.3, all those requirements are still in place. The number of floors will now be determined by the actual floor in which it's located. It's very simple. One is one. Single family homes can go up to 3+, and apartment buildings go all the way to 100+, and it corresponds with that 100th floor is in NFIP's eyes, the 100th floor. Once again, just to remove the complexity of what was NFIP and make it easier for everyone to understand. Okay, prior claims. Under risk rating, under the legacy system, prior claims are taken into consideration for severe repetitive loss properties and what was called PRPs and newly mapped programs. If there was losses, PRPs and newly mapped were not eligible. Under risk rating 2.0, NFIP claims serve as a direct rating variable and will be considered for all properties, all policies. Prior NFIP claims now take and consider a rolling 20-year window and take effect at their renewal after the first claim incurred after risk rating 2.0. So what we are saying, prior claims for risk rating 2.0, everyone is starting with a clean slate. Prior claims are not removed. They're just not shown as a direct variable until you submit your first claim under risk rating 2.0. Now, when you submit your first claim under risk rating 2.0, then all the prior flood losses will all come back. Now, there is something for severe repetitive loss. Severe repetitive losses is starting with a clean slate as well. However, they will still have to pay the SRL surcharge 15%. This will continue to be added on the annual premium until they experience the first loss under risk rating 2.0, at which point the surcharge will be replaced by the prior claim variables. So the severe repetitive losses they've often have a lot of claims, so they can come back and really impact their premium. The NFIP loss history goes with the building, meaning even if ownership of the building changes hands, the history and the new 20-year rolling period, it does not reset. And we're going to talk more about that 20-year rolling period here in a second. So when we're talking about losses, we mean actual losses. A couple of things are excluded, or the increased cost of compliance claims. Those are not considered losses. And claims closed without payment. And those claims closed without payment can either be the damage that exceed the amount of the deductible, or the homeowner submitted the claim while they were being evacuated, came back home and determined that there was no damage. So it was just a closed without payment. So here we're talking about the 20-year period for risk rating 2.0. Actually, let me move to the next one. This one is a little bit easier to understand. So we now have a 20-year window, which is an important concept to understand. Each claim has a 20-year expiration date for use and rating. That means that a claim in a policyholder's claim history is wiped away after 20 years have gone by. So far, any policyholders who have filed a claim for a loss incurred during Hurricane Katrina, that one claim will go away sometime around August 2025. So how does this look in practice? The date of the loss is used as a starting date for the 20-year window. Once the date between the date of loss and the effective date of the policy exceeds 20 years, that claim is no longer factored into the rating. And the new pricing methodology tacks on a load for every additional loss after the first claim is filed under risk rating 2.0. In addition to counting all previous losses with the 20-year rolling period. And why 20 years? Well, it's because the most consistent nationwide data that is available to FEMA goes back 20 years. So let's dive into the example that you see on the slide. For this particular example, the 20-year rolling period starts in September 2007, because that is the date of loss under the new pricing methodology. We look at the date of loss and not the settlement date. And after the 20-year rolling period expires in October 2027, claim number one rolls off, and this policy is left with two claims on their prior claim history. But one claim is forgiven, so to speak, under the new pricing methodology. So the prior claims factor is applied is 1. Another way to think about this is that a policy will be rated exactly the same whether it has a 0 or 1 claim. Starting with the second claim, however, there will be additional premium charged. And that prior claim surcharge factor to kick in before claim number 3 rolled off in 2027, but after it was filed in 2024. If you recall, policyholders will come to the new pricing methodology with a clean slate, and the prior claims variable will not kick in until after a claim has been filed on a policy already under risk rating 2.0. So a little bit of change there. The 20-year period, as we call it, the rolling 20-year, is something that's going to be continued, or it's something that's being added on, and it's going to help with the complexity of what was the old system, especially with old claims just staying on the flood loss history report forever. Okay. So you may be wondering, can any of these rating variables be changed or updated by the policyholder? Well, under risk rating 2.0, FEMA provides a lot of information. We provide the geographic variables based on the address that is converted to latitude and longitude. We provide the first floor height tool. We also provide replacement cost value, and where needed, NFIP claim history. So after October 1 of 2021, insurers and policyholders can provide information that can verify us. They can provide ground elevation that can either confirm or provide better rates for the ground and surrounding elevation by use of a ground survey. The first floor height, if they have the elevation certificate that shows something different, FEMA will always accept the information that is more advantageous to the insured. If there's an appraisal or some other replacement cost value tool that the homeowner has and wants to submit that, they can. And of course, NFIP claim history. Now, we have tried really hard to keep our claims records up to date, but sometimes due to 911 address changes or addresses that have been very similar in the past, we have claims on houses that never actually filed a claim. So we can do a review of that and make sure the claims are actually valid. If not, we can get that corrected. A few important points to note here. That one of the ways in which FEMA is attempting to streamline and simplify the user experience through risk rating 2.0 is by sourcing some of the data used for rating. In some cases, the policyholders may have more precise information than FEMA source, and we will accept those. However, this is not a blank check to challenge FEMA's data. Just as FEMA does not allow people to propose a different base map than the one found on the firm, FEMA will not allow people to use their own shape files of the coast or of the United States or anything like that. Instead, policyholder updates to FEMA source data are limited to a few cases. For example, if a policyholder has an elevation certificate, they can use fields from their EC to supply updated values for the structural low straight grade and or the first floor height tool. So it has to be something really stamped and sealed. Nothing's really changed from the legacy method. Now, unfortunately, the fees and surcharges have not changed significantly as well. The reserve fund assessment fee is remaining at 18%. The Homeowners Flood Insurance Affordability Act is still $25 for primary and $250 for all other. The federal policy fee did decrease by $3. It's now $47. Decrease from 50. And if there's a probation surcharge, if communities ever put on probation, every policy will see a $50 surcharge. So this is kind of a mock-up of what a declaration page is going to look like. And it's really important because you'll see here that red arrow is the full risk premium. This is the first time that the full risk premium has been identified through the NFIP. Now, when HFIA, the Homeowners Flood Insurance Affordability Act, was passed in 2014, one of the things Congress required is that the flood insurance premiums increase no less than 5%, but no more than 18% a year until they have full risk rate. The problem was they never identified what the full risk rate was. So it was an increase that was going to continue perpetually. It was forever. It was never going to stop. But now under risk rating 2.0, we do know what the full risk rate is. So when insureds get their declaration page, they will have two numbers. They will have the full risk premium, as you see on top. Then on the bottom, they will have the total annual payment. Now, if the full risk premium is lower than the total annual payment, that policy will decrease to the full risk rate, and then that's what the insured will be paying. But if you look at this example, the total annual pay is lower than the full risk premium. Therefore, this rate will increase by 18% a year until it equals the full risk premium. As you can see, this mockup also allows information to be seen, such as the mitigation discount. And this community is participating member of the community rating system, so they're receiving a $300 discount as well. It's also receiving a statutory discount of $200, an annual cap discount of $200. So every declaration page is going to be different, but this is kind of a mock-up. These numbers are notional, but kind of gives you an idea of what your insured can expect when they start getting their declaration pages on risk rating 2.0. One of the things that is important to remember about the full risk premium is that when a home hits the full risk premium, the increase for those premiums are to stop. Now that is assuming that there's no major changes to the replacement cost value or the ground or surrounding elevation around the structure. So for example, if someone built an entire new wing on their home, the replacement cost value is going to change, therefore their premium is probably going to change. If a community does a massive flood control project, it could impact the ground surrounding elevation, therefore it could impact the premiums. But if everything stays the same, the premium itself will not change. Now, that does not mean there could be some administrative increases, such as the reserve fund assessment fee, the policy fee, something of that could change, but the premium itself is not slated to increase once it hits full risk premium. So let's talk about what is changing. The statutory discounts we talked about a few minutes ago, such as the pre-firm and the newly mapped, they are changing, they're staying in place, but they are changing the way the discount is provided. And one of the major changes is that they're to be reviewed yearly by FEMA headquarters, and then they will set the actual percentage discount. But it's supposed to be 30% off the first $35,000 and the rest of the policy written according to the standard flood insurance policy. And also something to note here is the 30-day window for payments. FEMA has been very lenient before with people who exceeded the 30-day window. We often really helped them between 0 and 30 days late, and then 30 to 90 days, we still managed to get them back in their policies. Risk rating 2.0 won't give us that latitude anymore. Anything over 30 days will constitute a break in coverage, and that means the policy will no longer be valid. So coming back in, they would have to do the 30-day wait, and more importantly, they would lose any benefits they had, such as the glide path moving up to their full risk rate. they would have to come in at their full risk rate immediately. So it's really important that we stress the importance of paying flood insurance premiums on time. So the community rating system is changing. This is really a good thing for us. Before the CRS program really provided a great benefit to those who resided inside of the special flood hazard area. There were a few structures who may have been eligible for a maximum 10% if they didn't have a PRP outside of the special flood hazard area, regardless of whatever the community was rated at. For example, if they had a rating that gave them a 30% discount, the maximum homeowners outside of the special flood hazard area could ever receive is a 10%. Well, it's changing. The way the CRS is going to conduct its business now is that the percentage discount will be available for every structure in the entire jurisdictional boundaries of this community. Now, those who reside outside of the special flood hazard area will have to be at full risk rate, but once they hit the full risk rate, they're eligible for the full percentage discount. That is really a good thing. And as you can see, we have really started using this as leverage with the communities to try to gain their interest in joining the CRS. I mean, they're doing a lot of work already in floodplain management. I think a lot of communities out there would be surprised how much of their work that they're currently doing could equate to points under the CRS and possibly get them in and get them at least a 9 or 8 to get them their 5 or 10 points. All right, so I'm going to jump straight to this slide because this tends to answer a lot more questions. Here are some scenario-based situations, but first we have two columns. We have the legacy pricing methodology, which was the old system. Then we have the new pricing methodology, which is the risk rating 2.0. So structure 1 was inside the special flood hazard area. Current standard A-zone policy was built in full compliance. And under the legacy system, it was eligible for the full 30% discount that this community was awarded under the CRS program. Under the new pricing methodology, it will maintain that 30% discount. So structure 2 is outside of the special flood hazard area. The current standard is a standard X-zone policy. So it's not a PRP, not eligible for a PRP for some reason or other. So under regulations, the maximum is allowed for, and I'm sorry, it's also the zone X and built-in compliance as well. So the maximum benefit it could receive under the old system for CRS was 10%. Well, once this structure hits full risk rate, it will now be eligible for the full 30% discount. This is a big thing. Structure 3 is outside of the special flood hazard area. Current is a preferred risk policy, built-in compliance, non-applicable, while PRP policies were not eligible for a CRS discount, so therefore no discount under the legacy system. But once this policy hits its full risk premium, it will now be eligible for the full 30% discount. So structure 4 is inside of the special flood hazard area. It's new business, so it has to come in under full risk rate, but it's not built in compliance. Well, under risk rating 2.0, if a structure is not built in compliance, it's not eligible for a discount. So under the new pricing methodology, it will be no discount. Now, structure 5 is outside of the special flood hazard area. A new pricing methodology is going to be new business because it is a new structure, and it's outside of the special flood hazard area, so it's built in compliance and non-applicable. So it comes in a full risk rate from the very onset, so it receives the full 30% discount offered by the community. So the CRS program is changing in regards to the way risk rating 2.0 will deem it. So that's really good. Now, the next discount is machinery equipment. Now, machinery equipment is something that's going to be hard for a lot of structures to meet because it's going to be either all or none. And when we mean all or none, all the machinery and equipment have to be elevated to the proper floor to receive a 5% discount. Now, we know 5% is not a significant amount, but it can add up on other discounts and it can actually reduce the flood insurance premiums. But we are going to require all the machinery and equipment to be elevated to the proper floor. For example, slab on grade, the building is the only floor, all machinery equipment must be located in the attic. Now, that may sound like it's okay for water heaters and some air conditioners, but if you have a content policy, we're also going to require machinery and equipment to be placed on that same floor. That means the washer and dryer will be placed up the attic, and that's just not practical for a slab on grade foundations. Now, for basement type foundations, all machinery equipment must be located on the floor above the basement or higher. For crawl space, all machinery equipment must be located on the floor above the crawl space or higher. And for all other foundation types, all machinery equipment must be above the first floor or higher to receive the discount. So as you can see, the structures that are elevated, either pure pile and post or shear walls, are going to be more in line to receive this discount than structures that have been built in place on slab on grade type of foundation. And once again, it's a 5% discount, so it's not a significant reduction in the premium, but it will help. So here is another example of what we're talking about by the proper floor. Slab on grade is attic. A basement non-elevated is the floor above the basement. Crawl space, once again, elevated, the height of the floor above the crawl space. And over to the right, elevated without enclosure, pierce pile and post. It's going to be the first floor where the green arrow is. Elevated with enclosure, post pile or pier is the same. And it's the same with the elevated with enclosure, not on post pile or pier, some type of solid foundation walls is the same. So very achievable for elevated structures to receive that 5% discount. Once again, risk rating 2.0 is incentivizing mitigation credits and discounts to make structures more resilient. Now, another big change is flood venting. Now, flood venting was often associated with structures inside of the special flood hazard area. It's a requirement under 44 CFR 60.3. Nothing has changed there. But now the flood venting discount will now apply, just like the CRS, community-wide. So structures that have been outside of the special flood hazard area, but they decided to build on post pile or piers, some type of crawl space, they have flood venting. There's going to be a formula that's new, that is in the new flood insurance manual that could equate to 3 to 27% discount. So as the machinery equipment discount was only 5%, but they compound on top of each other. So you add that 5% on top of, let's say, 10% for flood venting, that's another discount. You add that into the whatever CRS rating is available, that's another discount. So it can add up significantly as well. Now, dry flood proofing is still allowed for non-residential structures. Is something that we still have to touch on, but it's not a method that's approved for residential. But all requirements for dry flood proofing in the flood insurance manual and 44 CFR remain the same. Let's talk about what is changing by what is going away. We already talked about grandfathering, so I'm not going to talk about that too much more. It's still going to be beneficial if they want to assign this existing policy to a new owner. It makes that house a little bit more marketable. A couple of things that are going away. We already talked about preferred risk policies. Simply that we're going to individual risk assessment. So we're not going to have, just because your location is in an area of minimal flooding, you get the lowest rate. The mortgage portfolio protection program is going away. This was a method for lenders to use to put forced place policies for those who did not have a flood insurance policy for mandatory purchase. But we had about 100 of those in our book of business. So just to remove complexity, we're doing away with those. And the submit for rate guidebooks, we used to use that for when we had unique structures. Say someone converted old plain fuselage into a home, or someone was 5, 6, 8 feet below the BFE. We used to have to use these rating guides to determine the premium. Well, the risk rating engine has been deemed so accurate that we don't no longer need that. A couple things that are still not changing is the mandatory purchase requirement, still based off of the flood insurance rate maps. And if your mortgage is touched by federal dollars, which almost all of them are, Fannie Mae, Freddie Mac, VA, HUD, they mandatory purchase of flood requirement of insurance will still apply. None of the floodplain management regulations are being impacted by this change for risk rating 2.0. You still use community compliance, 44 CFR flood insurance rate maps will still be used to determine compliance. Letter map amendments, letter map revisions, those are our letter map changes, can still be applied for, but however, they won't have the impact they once did on flood insurance premiums. Now, they can still remove structures from the special flood hazard area, removing the mandatory purchase requirement. But since we're going off of individual variables for that structure, it may not have the impact on flood insurance as it once did. The statutory caps on all of our products are not changing. The most we can increase flood insurance every year is 18%, unless it's a secondary or a severe repair of loss property, then that can be up to 25%. Increased cost of compliance limitation of $30,000 is not changing, and the coverage limits also are not changing. $250,000 coverage for building, $100,000 coverage for content for residential, 500,000 building, 500,000 content for non-residential. Now, we do understand that there is some legislation on the Hill that could impact these. But this was a requirement in place by Congress, so we could not change these on our own under risk rating 2.0. Now, the way increased cost of compliance, there's an additional fee that is collected to help pay for ICC claims. The way they are being collected has been changed. Now it's going to be a 1.9% of the total premium. That will be the fee for the increased cost of compliance. The underwriting forms have been tweaked just a tiny bit to incorporate risk rating 2.0, but by far and large, the dwelling, the general property, the dwelling, which is the structure, the general property, which is the content, and then we have the residential condominium building association policies. Those forms have not changed at all, and underwriting hasn't really changed at all because of the requirements of eligibility for flood insurance. Underwriting has not changed. The policies still can be assigned to new building owners. That is not changing, and this is important to under risk rating 2.0 because it allows the glide path to transfer to the new building owner as well. Transition of current policies. We're already in phase one. Phase one started October of last year for new business, and for any renewal that were to take place between October of last year and April of this year, can get a quote for both the legacy system and risk rating 2.0. And whatever one was more advantageous to that insured, they can opt in. So we've had a number of our insured customers opt into risk rating 2.0. And then we will implement phase two of April of this year. All our remaining book of business will transition to risk rating 2.0 upon the renewal time. It's important to remember that upon the renewal. So when April comes around, you don't automatically transition to risk rating 2.0, but you will at your renewal time period. Kind of touched on that a little bit. Okay, so when we are transitioning of current policies to risk rating 2.0, the insured have options. For example, if they had PRPs or newly maps, policyholders can change their coverage amounts and increase their deductibles. That could have impact on their flood insurance premium as well. It's important to remember to avoid the lapse in coverage if there is a change and there's a little confusion on the change from the legacy system to risk rating 2.0. I would encourage people to start contacting their agents now and getting quotes on risk rating 2.0, and that way they are informed and ready for this when they are set for their transition upon their next renewal time. So this is nationwide average. We expect 23% of our policies to experience a decrease immediately. We do see about $10 per month increase, so about $120 a year for about 66% of our policyholders. Those are the PRPs that are transitioning to risk rating 2.0. Once again, they had a subsidized rate that was incredibly low because they were not based off any risk. They were based just on their location on a firm. So now that we know what the risks are, their premium is more likely going to increase a little bit more. And then we do have about 11% nationwide that are going to increase pretty drastically. However, under risk rating 2.0, there won't be a single family home that has a policy over $12,000. And that still sounds alike, but currently under the legacy system, we have policies that far exceed $30,000 per year. So those reductions are going to be very helpful for a lot of people. So risk rating 2.0 website Equity in Action has been updated to include technical documents. Under that technical documents, for those of you who may be interested, are new data on levies. It doesn't talk about the rating methodology, but it talks to how levies are included in the risk rating 2.0 data sets. This answers a lot of questions because a lot of people are under the misconceptions that levies are no longer being taken into consideration for premiums. However, remember that the old system, you're only rated on one of two flooding perils. What we are seeing now that these perils and areas protected by levy often have 4 perils added on. So you have a higher premium, which makes it look like protected by levy is not helping. But in reality, just the level protection by levy is just being offset by the increase in the flooding perils added onto a policy. The Equity in Action, a fact sheet, it's a 6-page fact sheet. It's really good information to have for just general purposes. The risk rating 2.0 Equity in Action website is the one you want when you want detailed information and technical documents. So, okay, that was a lot. And let me go ahead and stop sharing my screen, and then we will start taking questions.
Have any questions?
I have one question about the built-in compliance. I just want to make it clear that if you have a map change and the BFE goes up, but you were built in compliance with the map that was in effect at the time, you're still built in compliance even though the BFE is higher, correct?
Yes, because that's going to be a pre-firm. Remember, pre-firm is not going away, but you had to have the policy in effect before the map change, or even the map change. You have 12 months after the
Yeah,
change
then
goes into effect.
That's not going to be pre-firm though. It's post-firm. It was
It's
built.
not- okay, it's going to be newly mapped.
Okay, all right.
Sorry, I got my discounts mixed up.
So this is Lauren Brinkman from City of Mandeville. I've been having a lot of residents come in, we're a coastal community. We have coastal V zones, A zones. A lot of contractors and builders are coming to sit down with me and saying, like, how are they supposed to prepare for the future of, I guess, new construction, more so of, I guess, how to plan for the 8 variables. Do we know what the percentage weight of how each of those variables will be weighted for the policy?
So under risk rating 2.0, those technical documents, there is a premium calculation worksheets. Now the numbers on those are notional numbers. These are just examples. But what you're talking about is really difficult. Under the old system, we were able to provide you with visual aids and talking points. For example, if you elevated your home 1, 2, 3 feet above the BFE, this is what your premium is going to be. But since we are going off of unique variables for each building, it's really difficult to do standardized talking points or standardized visual aid when there's such a variety of construction methods, types, and locations. So ultimately, it's important to remember that elevation under the old system is just as important under the new system. Now, you are going to receive more of a construction and mitigation discounts by elevating on pier piles and post, or elevating in general, than if you do slab on grade foundations. The purpose behind this is to really incentivize the way homes are built. So over the lifetime of a 30-year loan, you're going to receive less of a flood insurance burden by building with masonry product, by elevating on pure piles on post or some type of crawl space, by achieving the machinery equipment discount, by achieving the flood venting discount. All that taken into consideration will have a big impact on flood insurance costs.
Well, I guess I think the biggest question is having homeowners come in that are looking at, let's say, 3 or 4 different lots within your community. And they're trying to figure out how can they afford not only where the property is located, afford their homeowner's insurance, afford the construction cost of their home. And now with not having flood insurance, being able, I know that they're going to be able to sit down with a agent and say, like, how can you sit down with an agent and pre-plan to even know that you'll be able to afford the policy if you don't even know where? Does that make sense? Like, before, you're able to say,
Absolutely,
okay,
yeah.
as long as I build so high, or I do this, that, and the other, versus now they don't even know what property to purchase because of all the different variables that come into play.
Well,
Even
they
though
can
afford
do
it.
quotes based on construction drawings or plans. So they can get quotes based off of numbers that they just have on paper.
I guess that matters if it's mandatory or not, if they have to carry it. There's just a lot that goes into that.
There is, and honestly, the location is going to have a big impact. It's going to have a huge impact, distance to flooding source. If they want to live around water, they should expect to have a higher flood insurance premium. If they're going to, especially in low-lying areas, and I know this is really difficult in Louisiana because there's a lot of the state is below sea level. Rainfall is now taken into consideration, which wasn't before. And Hurricane Harvey, 52 inches of rain fell in just stationary locations. So much rain fell, it would fill almost a foot of water over the entire state of Texas. So those are taken into consideration as well. So there's some impacts that the homeowners can provide and can have impact on the flood insurance premiums, but the location is going to be a big factor. The ground and surrounding elevation is taken into consideration before the home is even built.
This is Monica Farris. I had a question that's sort of a follow-up to what you were just talking about. And you mentioned earlier in the presentation, they'll no longer be publishing standard rates, and that only insurance agents at first will have access to the rating software. Is there a plan to eventually roll out access to others, like local officials?
Not local officials, but other insurance staff such as FEMA, like for example, myself. I don't have access to the engine, so I can't even conduct reviews. I can't verify if a rate is properly rated right now on the information that was done in the application. So the plan is to provide the flood advocate's office, regional staff access to the engine so we can start reviewing and making sure that the policies are rated up based on the information that was provided in the application. As for a general roll off to city officials or open public in general, there hasn't been any talk about that.
Thank you.
This is Jessica Cornet at Lafayette. Do you have a list of the flooding sources? I mean, I have 900 miles of open channel in my small parish. So I'm assuming not all of those are going to be included as a flooding source. So is it what is shown on the maps? Are those the flooding sources?
So distance to flooding source is about 1,000 yards. So if you take a look on a location you're interested in or have questions on, you do about 1,000 yards from there. If there's a major flooding source, river, canal.
That's what I want to know is
Yeah.
what is considered major? Does it have to be listed like in a flood insurance study for it to be considered a major flooding source? Or is it the Vermilion River? You know, is
Yes,
that-
river is going to be considered a flooding source. Not tributaries
So-
coming off the river, not so. Little small
Yeah.
canals, drainage canals or not. We're talking about a significant flooding source. The examples they provide are the ocean, the Great Lakes, rivers, major flooding sources.
Okay, so like a lateral, like I have lateral 9A, which is pretty far down. That wouldn't be considered a flooding source, but my highest concentration of RLs is on that lateral. So,
But yeah, if you want to send me an email, I can send that up to underwriting for a review on that. What is the definition of their flooding source? But they don't break it down any more than that for us. Yeah, it's not going to be a small tributary or creek or a canal. It's going to be something of significance.
Even if it's in the zone.
The zone doesn't matter.
Yeah,
yeah, so it doesn't matter.
well, that's good. Maybe I can finally get out of the flood zone.
I thought you did.
No, you're in the flood zone.
Well, I got a Loma, but it's not gonna
So
happen.
they're still subsidizing basically Lomar Fs. Because if you can Lomar F out
But
with
it's
flood
not,
zone,
it's not gonna change. All it's gonna do is change the requirement. It's not
Right.
gonna change the.
but if you're
premium.
not, if you're not required to have insurance, you think you're gonna go get it now?
No.
That was absolutely right, though. The only thing it will do is reduce or remove the mandatory purchase requirement. Their flood insurance premiums will be based off the risks associated with the building's variables.
So has FEMA predicted of the 66% that have the preferred risk right now, how many people are actually gonna continue to carry that? As there's an 18% increase on that from year to year?
I don't have those numbers. I can probably look and see what the breakdown is for Region 6. I expect a decrease. In fact, we're seeing decreases in all of our states in Region 6. I think we're down like 20,000 policies in Texas. I haven't looked in Louisiana.
And that's just since
So-
October.
That's
Gil,
since October.
Upcoming foreclosure.
One issue that came up recently, I think it was in Jeff Davis, we had a developer and I think they reached out to you. He was wanting to develop a neighborhood, and we contacted an insurance agent so that we could at least try to see location wise what it was going, the premium was gonna be. But the problem they had was there were no addresses. So the agent couldn't even enter an address. And she said they didn't have the ability to change it to lat long or anything. She had to have an address. So how are they gonna deal with, like what Lauren said with the developers trying to figure out when they can't even rate it without an address?
Yeah, that's interesting because we received another complaint from a agent who is required to put in nothing but latitude and longitude as opposed to home addresses. So the troubleshooting team for Risk Rating 2.0 is working on this. They're trying to figure out why home addresses were not accepted. And also if a latitude and longitude is to be inputted, the format in which the latitude and longitude is to be used. So therefore we get consistent information. The situation from the agent who is using latitude and longitude was that he got his latitude and longitude from multiple open sources. You type in a search engine, how to get latitude, longitude, he would ping, he would pin it, but he used multiple different sources and they all equated to different premiums. So that's obviously a concern and something that the team is working on. So that's something that is being worked right now, because the way it is supposed to be worked is to go off of the address. The address will be converted to Latin long and then it will be pinged off our data set. So even if there's not a home there, the risk rating engine is supposed to have a mapping viewer in which you can kind of pin the exact location and convert that to latitude longitude. But as I said, I don't have access to the engine, so I don't see exactly what the agents are seeing right now. So what they're telling us may not be what the actual agents are looking at. So, but that is being worked.
Thank you.
So to be able to answer all 8 of these variables, is the, I guess, insurance agent just taking the resident's word of what's happening? Are they sending out a agent on, like, boots on the ground? Like, how is this being determined? Just trust method?
Everything is self-reporting. The agent and the insured will fill out the application. Now, some things will have to be, document will have to be submitted for underwriter review, such as proper flood venting, construction methods, if there's plans, so stuff like that. But it's all self-reporting. And now keep in mind, we're allowing it to be self-reported, but if there is a claim and our adjusters determine that it's not accurate or truthful, then they will be rated. The premium will be properly rated, and then whatever premium was due will be taken out of any claim checks that they have coming. So it's not in any of our insured interests to not be truthful on the application.
I have another question. This is Monica Farris about, I just want to clarify. So you mentioned the full risk premium will be noted on your deck page. And it's updated only when the homeowner adds to the home, substantially improves the home. It's supposed to stay the same. And I'm asking just because we all know that risk changes, right? Especially in South Louisiana, we have subsidence, sea level rise, coastal erosion, I can sit and name, so we know. So are we saying FEMA is not going to go back and re-rate these policies ever?
No, we're not saying that, but there has to be a substantial change. So I use the house as an example. So as long as the variables that were used to determine the rate, right, as long as they remain unchanged in a significant manner, then the premiums will not increase. But if there is a significant increase or a change in a study that shows that erosion in this area or is that of a greater concern, then there could be a premium increase, but it's not going to happen every year. So there has to be shown a significant change. Once a structure is hit full risk rate, there will have to be a significant change to the variables in order for the premium to increase again.
Okay, thank you.
Yeah, but also keep in mind, under the old system, the legacy system, the rate increases were averaging anywhere between 11 to 15% a year and would have continued.
Right.
Okay.
Are there any other questions? Thank you, Gil. I'm sure we might have questions later, but we appreciate the presentation. I know earlier or in the agenda, we were looking at CRS standards and looking at local ordinance upgrades. Maybe we want to discuss first the minimum standards. Gil, if you could maybe provide some of that information, and then we can have Michelle Olivier speak about the higher standards that maybe we could strive towards for certain local ordinances.
All right, so minimum standards for the CRS, okay. There has to be interest from the community, and they would normally contact my office. Now, we have some latitude at the regional level on a community who wants to join, but our set policy is that when a community shows interest, we then do a CAV. Now, there's no difference in the way a CAV is conducted. We call this one a CRS CAV, a community assistant visit. And the purpose of this CAV is just to ensure that the community is full compliance with the floodplain regulations that the community had agreed to when they joined the NFIP. The reasoning behind this is the CRS community is expected to have a CAV open and close within 6 months' time once they join the CRS program. It's a higher standard, so we hold these communities to a higher level. Now, once we get a CAV done and the community does get this CAV closed in a 6-month period, then we will tell our ISO that let's go ahead and take the next step. And then they will reach to the community and start conducting reviews with them to see how many points that they can earn. Now, this can take a while. So let's just jump up and that the community has achieved enough points for a class 9 to join the NFIP with a 5%. Now, the community will have responsibilities after that. Now, these responsibilities I'm going to discuss are really the bare necessities that community needs to maintain to stay into the NFIP and not be retrograded. We don't like to remove communities from the CRS program, but we will retrograde you back to a 10, which you won't receive any type of a CRS percentage discount for all of your insured policies. But we try to work with you to help you ensure that you're in compliance. So just bear with me here. All right, so community responsibilities. First and foremost, you have to designate a CRS coordinator. We have to have someone who our ISO staff can contact, ensure that the information sharing is happening, that the information that the ISOs requested are provided to them so they can conduct their reviews to ensure that the correct number of points are still there and that the community is doing everything they're supposed to be doing. They're supposed to cooperate with the ISO and CRS specialists to ensure the verification process is being adhered to. And they have to understand that they're going to be recertified every year that is continuing to implement its activities. So the CRS is not something you just join and that you don't have to work for it anymore. It's something that's revisited every year. And the committee also has to advising FEMA and its ISO specialists a modification to its activities. So if a community is a class 9 and they're making major changes, they want to achieve a better score, notify us what these changes are happening, and therefore we can help monitor and provide information to help you get to a better score. For example, we had the community of Tulsa, which I am happy to announce is being rated as a CRS class 1 in April of this year. That's only the second community in the entire nation to achieve that. And that means a 45% discount for every policyholder in the jurisdictional boundaries of Tulsa. Now, keeping elevation certificates, old firms and flood insurance studies, as long as the community is in the CRS. This is important. One of the biggest things I see a lot when my ISO coordinators are working with our communities are improperly filled out elevation certificates or lacking of elevation certificate. It's a requirement. You have to have that in order to stay in the CRS program. Now, we require a 90% accuracy on the elevation certificates. So it's really important that the CRS coordinator and the floodplain management staff for that community understand how elevation certificates are still needed. Now, I just talked about how elevation certificates were not going to be required for insurance. Now, this is the importance that remember there's a difference between compliance, which we were talking about now, and insurance. So under the compliance side of this, or the floodplain management side of this, if you will, it's still required that the elevation certificates, old firms, and flood insurance studies, the FISs, be maintained as long as the community is in the CRS program. The also minimum standards are keeping the records irradiated in the activities documentation sections until they are reviewed at the verification visit. So all documentations have to be kept and ready for that review. Also, minimum are ensuring that flood protection projects and drainage systems maintenance activities are compliant with federal environment and historical preservation requirements, and participating in cycle verification processes. So those are the basic necessities of joining NFIP and maintaining a basic level. Now, we'll let Michelle talk about the higher standards and how to achieve those points moving in. But once you get in, what I just talked about is the minimum needed to stay in at the level that you came in as. Now, we always encourage communities to strive for better scores. I know Tulsa has done work, and they have been doing work for decades on their flood prone areas, and we know that's not easily done, and it was an expensive process. So not every community can achieve those scores, but even a class 8 or class 7 with those percentage discounts can really offset any 18% increases that we see a year. It could offset an entire year of increase under risk rating 2.0, maybe help some homeowners who are going to have a significant increase because of the rating variables now under risk rating 2.0. So that's kind of it in a nutshell of minimum standards and joining the CRS and maintaining the level in. Let me hand it over to Michelle now to take over for the higher standards. Thank you.
Thanks, Gil. Gil, I have a question real quick. In the past, when a community was looking to join the program and they submitted their letter of interest to you, they also had to complete a quick check. Is that still required by Region 6?
It is, and I'm sorry I did not touch on that, but yes, there has to be a letter of interest followed by the quick check. You can, when you reach out to me, if you don't have the quick check, we will get that to you. We will also provide you a what if. It's a scenario based off of our community information system. We can kind of give you a what if, how, and that will have a breakdown of the number of policies that are in your community, and what if is what the prices that they will save at certain CRS levels. So we can provide that. And then of course, the quick check is really important because it gives an idea of where you stand point wise. As I mentioned earlier, communities are doing a lot of work that could equate to CRS points. For some reason, they're just hesitant to call and reach out and join the CRS program. But a lot of that work's being done now. So the quick check is a way for us to capture that. And it's a way for us to capture what points the communities are willing to start implementing to earn the additional points needed to join the CRS. So yes, still required. My apologies for leaving that one off.
Thank you very much. I just wanted to be sure that was still required. And to clarify or build on what Gil said earlier, to join the program, you need to have at least 500 points, 500 credit points. And there are some minimum requirements as far as the activities are concerned. 310, as he said, activity 310 with elevation certificates and maintaining that 90% accuracy and enforcement of your codes that show on those ECs is one of those. And then depending on your repetitive loss number, you are categorized as either an A, B, or C community, and each one will have its own special requirements. So there's a few other little minor things, but as far as activities go, that's the only activities that you really have to do. You'll probably need to do more than that to get points, because there's no points awarded in the rep loss category activity 501. But if you have a hazard mitigation plan that addresses those repetitive losses or repetitive loss area analysis, then that's point worthy. But anyway, again, great job, Gil. Thank you very much. There's some minimum requirements to get in when you're really, really ready and think your community's on the verge. You can let one of us know, and we'll be glad to help you jump on board. Speaking of higher standards, we're going to talk real briefly about freeboard. Of course, the number one benefit of freeboard is not going to be just the CRS points. It's going to be the actual flood protection that the property or the structure receives from the freeboard. But we're going to move through this pretty quick. I'm going to split it into two areas. One will be to be a class 8 or better. You have to have certain language in your flood damage prevention ordinance. And then to get the most points out of activity 430, you need to have certain language. So we're going to kind of talk about those two areas. So keep going. We don't need to look at all that. You guys know what we do. We're the CRS program. we want to help the NFIP reduce and avoid flood damage to insurable property, strengthen and support the insurance aspects, and then of course, foster the comprehensive floodplain management. So we've been over this before, you know what we do, so we can keep moving. So what is freeboard? Freeboard is actually a Navy term, but the NFIP's definition, next slide, please, is basically what you think it is. It's a factor of safety. So if you're required for your finished floor to be at 5 feet and you build to 7 feet, you would be considered having 2 feet of freeboard. Freeboard is supposed to compensate for those many unknown factors. Can you do one more click? There it is. In other words, go a little higher, because back when we were using FEMA firms, they might not account for climate change, man-made changes, subsidence, extreme weather events, etc. So that's what freeboard does. It compensates for those unknowns, or those things that we can't really calculate. It's just too difficult to calculate what their impact would be. So now we'll talk about that Class 8 freeboard prerequisite. To be a Class 8 or better, communities have to adopt and enforce 1 foot of freeboard for residential buildings in all of the numbered zones of their SFHA. That includes the mechanics and equipment. It applies to mobile homes, and it even applies to those in those pre-firm mobile home parks. And you'll see why I kind of clarify that right there, because all of our model ordinances have the 36-inch above grade language. That's not going to be acceptable for a Class 8 or better community. So the most commonly asked question about this freeboard, remember, it applies only to residential. That's the big key here. So we rarely see flood damage prevention ordinances or ordinance language where residential structures are allowed to dry flood proof the mechanics and equipment, or machinery and equipment. So the question we get the most is, can machinery and equipment be flood proofed instead of elevated to meet the Class 8? And the short answer is no. A community that allows flood proofing around machinery and equipment in lieu of elevation does not meet the prerequisite. But remember, this is only for residential. So if your residentials have to elevate your machinery, then you're fine. It maybe you allow non-residential to do the flood proofing. That has no effect on the Class 8 freeboard prerequisite. So this is a very helpful little diagram that we've shared before, and if anybody wants a copy, just ask for it and we can send it over to you. This is what to do about those attached garages. Remember, in Gil's presentation earlier, for insurance purposes, this doesn't matter, but for compliance, it does. So this is just a great little set of diagrams that can help you figure out if it's going to be a minus rated structure or a non-compliant structure. How would you rate that structure if you were having to do that for the legacy method? But it also can show you compliance for the regulatory standard. So let's look at some sample language. This is straight out of Louisiana. I don't remember which communities, straight out of their ordinance off of Municode. Most ordinances, most of the flood damage ordinances are divided into 2 sections. There will be the general standards, and then you'll have the specific standards. So the general standards say, there's a bunch of stuff in there, but very seldom will you find elevation of the finished floor in general standards. Usually you find elevation of the floor in the specific standard for that type of flood zone or that type of structure. It depends on how the ordinance is set up. So you'll notice at the top, it doesn't really specify that the machinery and equipment has to be elevated to 1 foot for residential construction. But on the specific standards, it does. So the top one, if you were just looking at general standards, the top one would kind of flag me or kind of alert me to say, hey, I hope they have some elevation requirements, some freeboard in their specific standards, because they don't have it in their general. And then I'll go down to the specific standards, and there it is. And it specifically calls out machinery and equipment. So this particular community has 1 foot of freeboard, actually two, let's see, yeah,
Yes.
1 foot, yeah. And we're only concerned with the BFE. You may very well word your ordinance so that it has to be so many feet over the center line of the street, or so many feet above the adjacent grade, or so many feet above the base flood, whichever is higher. You're free to word your ordinance that way. We're going to give you credit in CRS for what is measured to the BFE. That way you're always going to be at the higher level. So in this particular example, if the top section had the 1 foot of freeboard for the machinery and equipment, it would be fine. That would indicate to me that every zone, every construction type, unless it's said otherwise in the specific standards, would have to have the M&E elevated. So I like to see communities put it in their general standard so that you don't have to worry about putting it in each specific section of your ordinance. You absolutely can, but you may not, maybe you don't have any AO or AH zones right now, but it's listed in your ordinance. So you think, oh, I'm not worried about it. Well, you want to just get it all covered now so that there's no surprises later. So the top alone does not meet the prerequisite, but the specific standard does. So here's that infamous manufactured home language that was in the model ordinance, and everybody's and their brother has this in their ordinance. So it'll say that the lowest floor of the manufactured home is 1 foot above base flood elevation, or the manufactured home is 36 inches above grade. Well, that word or is the issue. So we're talking about pre-firm parks here. If you leave the or and then the number 2 section, you would not meet the class 8 freeboard prerequisite. So the easiest thing to do is to take off the or and the number 2 paragraph and just leave it at the floor of the manufactured home is a minimum of 1 foot above base flood elevation, period. No other option there. So, and one more time, maybe 2 more times.
And that's really confusing, I find.
Yes.
But it's because you could have a mobile home that's at 36 inches and it's not 1 foot above freeboard. So
Right.
it gives you the 2 options.
Right. So it's just so much easier just to leave it at 1 foot above. And now we've seen some communities who change that or to the word and, so that it has to be both. You have to be at least 36 inches above grade and 1 foot above the BFE. So that's an option too for some places. Okay, so that was the class 8 freeboard language. Now let's look at how do you get actual credit points in activity 430. So there are some things that will impact your 430 score, and people forget that. I know when I was a coordinator, I saw 100 points for 1 foot, and I thought, oh great, maybe we can get 1 foot passed in our ordinance, and then we'll get that 100 points. It doesn't work quite that way. So that particular activity is impact adjusted, and that means that we take out of the SFHA acreage, we take out any place that those regulations would not have an effect. So for example, if you have some preserved open space, nothing will ever be built there. So those regulations will never have any effect there. So we back that amount out of the total, and that is your impact adjustment. We also looked at your elevation certificate evaluation report to see how many certificates actually indicate that you are enforcing your ordinance. And if you have too many errors, it reduces your credit. And if you have less than 80% correct, there's actually no credit in freeboard for you. And if you have too many machinery and equipment below the DFE, like maybe you had a 2 foot requirement, but you're only making them do M&E to 1 foot, then that'll reduce your base credit to 75%. All right, so here's the base credit. Remember, this is base credit. There's an impact adjustment and there's a verified ratio that will affect this score. So if you have just plain 1 foot with no can't spit it out, compensatory storage requirements, then it's 100 points. 2 feet is 225, 3 feet is 375, and so on. So here's a quick little chart on kind of when you can expect 50% base credit, 100% base credit. So if you have 1 foot of freeboard for floors and M&E only, all residential, all numbered zones, but no non-residential, it only applies to residential, we're going to cut your base credit in half. So you want to apply it to all structures to get the most credit. So you'll be starting off with 50 points instead of 100. If you require 1 foot for floors and M&E on all structures, there's no option for floodproofing non-residential M&E. It includes manufactured homes and parks in all numbered zones. That's 100% base credit. So you're starting off with the most points there. And then if you do 1 foot of freeboard for all structures, but non-residential gets to floodproof their M&E, well, then you're going to be back down to 50% credit, or maybe 75, not 70, 50,
75.
maybe
For the
75
machinery, yeah.
there, yeah, because it's machinery. And then the last one is freeboard for floors and all machinery and equipment for all structures with the option of floodproofing to the BFE +1. There's your freeboard in the floodproofing in all numbered zones. So you'll probably start off with 100% base credit. Again, the only thing you need for that, one more time, the only thing you need for that Class 8 freeboard prerequisite is what's going to get you the least amount of points in Activity 430. So just keep that in mind. You can go one more. All right, so let's look real quick at how the points shake out when we apply the impact adjustment and the verified ratio. So this pretend community has a foot of freeboard for all structures in any zone, including their M&E. Unnumbered A zones are required to have a BFE determined. Their AH and AO zones require 1 foot of freeboard if the depth is known, and 3 foot if the adjacent grade is if the depth is not known, and 3 foot above the adjacent grade if the depth is not known. So they are a 10,000 acre SFHA. They have 3,400 acres of open space. They're not getting any what we call DL2 credit. That's just a development limitation credit that prohibits certain things. And their elevation certificate evaluation report, they got all 45 certificates correct. There were no freeboard errors. So the calculation would be 10,000 acres minus 3,400 acres, because remember, your freeboard does not have any effect on your preserved open space. So you have to take that out. That leaves 6,600 acres, which is 66%. The verified ratio was all of them, so it's 100%. We multiply that times the base credit. And so out of 100 points, you got 66 credit points. So open space, don't worry, in this particular community, that's a lot of open space. They got a lot of points in open space. So it looks terrible, but that's how it works. Go to, yeah, leave it right there. That's good. So this is the same exact community. The only difference is instead of 1 foot, it's 2 foot. So their base credit is 225. Same acreage of SFHA, same open space, same characteristics, same everything. But their base credit was 225. After all of the impact adjustment and the verified ratio, it's 149 credit points. Here's one where, let's see, oh, they had some errors on their elevation certificates. They had 5 errors, so that cut their base credit down to 58 points. And this one, they had, they don't require all the zones. They do the minimum numbered residential for freeboard to meet that Class 8, but they don't do much else. So it cut it down to 61 credit points. And again here, this is because they didn't require non-residential, they got only half the base credit points. So instead of 66 points, they got 33. So how can you increase that credit in activity 430? Well, you want strong ordinance language. You want to require at least 1 foot, preferably more, for all structures in all zones, including flood proofing of non-residential to the freeboard level. Include the language for mechanics and equipment or machinery and equipment. Same as above, but require higher than 1 foot of freeboard. Regulate the 500 year or include compensatory storage requirements. If you're not coastal areas don't usually do compensatory storage, but if you're not coastal and you're maybe riverine, including those compensatory storage requirements can up your point value a little bit. But the biggest thing is enforcement. What we're finding is that communities have great language, but terrible elevation certificate evaluation reports, lots of freeboard errors. And it's not intentional. A lot of it is an incorrect diagram number or something simple that can be corrected that makes it look like section C is non-compliant. So be sure you look over those ECs, know the requirements for the building requirements, not so much for insurance, because there's really no way to know that right now, but for building, you know what the requirements are and you communicate that to the developers. And enforce it. Make sure they're meeting the freeboard level. I just cycled a community who has 3 foot of freeboard in Texas, and almost every single certificate, their M&E was 2 feet. So it was a standard policy that they'd allow. The finished floor had to be 3, the M&E had to be 2, but it wasn't written down in an ordinance. They lost a lot of credit because of that. And then when I say 2 feet, they would go if the height was 50.3 would be their required height with 3 foot of freeboard. Their M&E would be 50 or 49.8. Like why? Just come on, just go that 3 inches more. Like what is the deal? So make sure it's being enforced in your community. And encourage pier and beam foundations. That is not encouraged in Louisiana. It used to be, and we'll take a look at that in just a second. But way back in the 50s and 60s, slab on grade became the cheaper, quicker way to get a lot of housing built for a lot of different reasons. And so we kind of stuck with that. Keep going. All right, so Class 8 freeboard only applies to residential, but you got to include the mobile home stuff. Including those in the prefirm parks. And then for 430 freeboard credit, to get the most out of your credit, you want strong ordinance language plus enforcement. Don't leave off the enforcement. It's got to be enforced for all zones, including non-residential and all structure types. All right. Before we take questions, I'm going to just briefly tell you why I have plantation homes on here. You can go one more. We always talk about the most recent floods from Katrina on. I mean, Katrina, then Harvey, then Rita, Ike, and all that. But these are pictures of the 1927 Mississippi River flood. And that is Breaux Bridge and Lafayette in the bottom left. That's Lafayette on the bottom right. I can't remember. That's Tallulah in the top. That's Northeast Louisiana. But Lafayette became a tent city during that time with refugees and survivors. Our ancestors knew what they were doing. When you look at plantation homes, they're all built above the ground for a reason and not in the immediate floodplain. Typically, the lower class people lived next to the natural levee. And then you had the regular floodplain, and then you had the higher land on the other side of that. That's where your plantations were built. That's why we copied over the French arpit type of land design when we would sell property and build property. But anyway, our youngsters don't know about these old floods. So once in a while, we need to remind them that it's not just coastal areas that flood, it's everywhere. And that was 27, but in 1918, before the levees, was on flood before that. And then in 2017, was that our big?
2016.
16 was the other one. So
And then 1940, yeah.
yes. So All right, any questions about Class 8 free board prerequisites or free board credit?
On that example you gave about Texas with the M&E, if they amended their ordinance,
Yes,
would that bring them back into compliance?
yes, that would,
Okay.
we would have to split their credit into finished floor credit and then M&E credit. And free board, it would be 2 occurrences. So if they would just require 3, put it in the ordinance and then enforce it, that would be, it was like almost, because it's such a large county, it wasn't a small city, it was a county that I was cycling. That was almost a class in free board credit by itself. Yeah. And they lost a good portion of that, so.
And one thing with the unnumbered A zones that I know a lot of communities dealt with, because I did, even though your ordinance, most ordinances just say, you know, in areas where base flood elevations have been determined, the specific standards apply, but they enforce free board like we did. We always had a BFE in an unnumbered A zone, even though your ordinance may not say that, we enforced it that way, but it's all about what's in the ordinance. And so even though you're enforcing it a certain way, if it's not written down, then it's hard to get.
It's hard to get credit for it, even though you're doing it.
Yeah, so make sure to include those unnumbered A zones, like specifically.
Like say that a BFE will be
Mhm.
determined at development time.
Yeah.
And free board will apply.
Anybody have any questions? Maybe one in the chat or a comment? I lost some.
I have a question related to elevation certificates. When you submit elevation certificates for review, do you submit all the certificates or do you only focus on the certificates in the SFHA?
The SFHA, whatever your regulatory floodplain would be, but you're also only submitting how many at annual cycle? I mean, annual CC?
All of them from the year, because it's
Yeah.
only from a year, but where people get confused is it's only new construction, substantial improvement of insurable structures. So we don't want to see storage buildings or anything like that.
Okay, so everything, including those outside the SFHA.
Well, no, not for the annual CC, but he probably would for 430 credit.
Yeah.
But just for your annual CC that you're submitting for them to check for errors, you're only going to do the SFHA.
Okay.
Regulating your 500-year floodplain is like an incredible way to get a lot of points.
Mhm. And a lot of communities in Texas are doing
Yeah.
it big time.
Yeah, it makes your, it reduces the impact of that impact adjustment. So instead of like only 66%, you might end up with over
Mhm.
1.25 or something like that. So it really brings the points up.
Did Texas do that after Hurricane?
Yeah, Harris
Yeah.
County Flood Control made the communities adopt the 500-year in order to get certain funding. So a lot of the communities there are doing that.
A lot of grades, either highly encouraged or required, depending on.
Mhm. Yeah, Pasadena, Texas, they have some crazy regulations.
Apparently so is Tulsa.
Yeah.
Yeah. So we're gonna be with Roseville and be a class 1.
Maybe one day we'll get there. So if anyone has any questions, I know we have like a couple minutes left. I know previously we had talked about a group name and we had a suggestion from Melissa Becker. It's kind of variation. So I don't know if anyone wanted to kind of discuss. I like the idea of raise, or this is important to the group. Again, you can kind of maybe play around to regional, either Alliance or Acadiana, since we're the Acadiana region. Informational, sharing or support.
I like the Regional Alliance Information Sharing Exchange, but there's,
Yeah,
it's
that's nice
kind of, there's no, well, I guess float. It float.
water.
Yeah, I was just
Just
trying to incorporate some sort of CRS, but I like
Yeah.
that, Regional Alliance Information.
It was a good suggestion, only suggestion we got, but obviously, you know, we're an informal group. So if y'all want to add to that, or I can send out a follow-up email, again, like kind of no pressure, but have some options. But so just saying the LWI Region 5 CRS user group is kind of boring. We could have a name, so you know, it's standalone. Maybe encourage some people. I like the idea of raising, maybe, you know,
Yeah.
literally and figuratively
Yeah,
raising
that
each other
sounds
up.
like that.
Okay, for our, again, I'll send out a follow-up email. For our next meeting, those are normally part of the CRS user group email. The last time we met was November. I think we kind of said maybe every 2 months. So here we're in February, and if y'all want to meet again in May, if that, or if anyone has any objections, or again, feel free to email me if the every 2 months is good. And of course, be thinking, and I'll kind of prompt people before then for agenda item suggestions or anything you'd like more information on. And just going back to the minimum standards, I know we said this again in November, but looking at that CAV visit, and you said that the quick check, if people are interested and aren't joining the CRS, I guess schedule your CAV visit would be like one of the first steps, or contacting maybe Michelle.
Or Stephanie or Jennifer
or-
or Michelle, yeah.
Okay,
either-
or Stephanie
Any of
Weeks.
us will get the ball rolling. We'll help them get the ball rolling.
Okay.
The quick check can be done with Stephanie or Jen or myself. If the community doesn't really understand it and they want some help with it,
Yeah.
we do those meetings all the time. They can be a virtual meeting, doesn't have to be in person. So.
And it doesn't matter, like, I went and sat with Garrett,
Right.
even though he's not my community. I mean, it made more sense. I live like 2 miles
Right.
away from
Right.
him, so I
Right.
went
Convenient.
instead of Jen having to
Yeah.
come from Baton Rouge, so we're happy to.
Yes,
we work
anybody
together.
can help you, so.
Perfect. You just want to stress out there that we have this wonderful resources here. These 3 individuals, they're willing to help. So please contact them, and I really appreciate that. Okay, if there's any other comments.
I do
or-
want to just say,
Yeah.
if ever, just
Please.
before we
Yes.
leave, LFMA, our annual conference, if y'all don't know, is April 6th through the 8th in Baton Rouge at the Marriott, and you can register online. So we hope to have a good turnout this year, because we haven't had one in 2 years, so we're ready to get back into the swing of things.
April 6th through 8th.
April 6th through the 8th.
Okay,
yeah.
perfect.
It's a
I can send-
Wednesday to Friday, I believe.
I can send out that information.
And
so
the
for a
CFM
follow-up.
exam at the lead, we're gonna be doing a CFM exam as of right now, unless something's changed, but after the conference, we'll have that.
Great.
I have a quick
Stephanie,
announcement, if that's
Send
okay.
out that information as well in the follow-up email.
Floodplain
Oh.
Louisiana Organizational Work Group.
I like that too.
Yeah, but
Oh.
it is a regional, so we need, I think, probably focus on the regional, not necessarily Louisiana.
Yeah, but just, keep pouring the names in.
Yeah,
Appreciate it. I like flow.
This is Monica. I just have one quick announcement, sort of request, if that's okay.
Oh, yeah.
Those are as local, I mean.
It says Louisiana.
No, but I think what she's saying is floodplain, like
Could you-
change,
the L to
yeah,
local.
change the L to local, the Louisiana to local.
That's it.
Mhm. Thank you, Ashley.
All right, if there's no other comments or questions, we can adjourn.
Monica had something
Thank
to.
y'all all for joining us online and those that are joining us in person. Until next time.
Can
have a
you
good
hear
day.
me? Monica, I don't think they can hear us.